Chapter 15, Owning Stocks. Stocks are a representation of ownership in a corporation. So stocks represent the number of shares in the company's future and the right to have a say in how the company is run. Now, the original owners are often the inventors or entrepreneurs, and they can choose equity investors who share their ideals and vision for the company. So in the example over here on the right, Mark Randolph and Reed Hastings founded Netflix in 1997. And at the time, it was actually a DVD by mail business. Usually, the first equity investors of the original owners are friends, family, or colleagues. And they generally allow the original owners or founders the freedom to manage it how they want to because it's their company. But they're investing in hopes to see it will grow. The company at that time is considered privately held. And you can trade company stock between owners privately. When a company is privately held, their information and their inner workings are private. It's not known to the public. There's no reporting involved. So for the first couple of years that Netflix existed, it was a privately held company. Now, a company can seek out an angel investor, a venture capital firm, or private equity firm to get more investors or to get more money and build capital for their business. So an angel investor is a wealthy private investor. So that's someone who's got a lot of money and wants to invest in a company. So think on the individual basis. Whereas venture capital firms and private equity firms are groups where the investments are managed by professional investors. Whereas the venture capital firm tends to focus on smaller investments in companies who are in their early stages. They tend to minimally control what's going on, and they're hoping for long-term growth. Whereas a private equity firm tends to do larger investments in more mature companies, and they want a lot more control. In some cases, they actually completely buy a company and then break it up or manage it or restructure it and sell off the parts. So there's different purposes for each of these firms. So the show Shark Tank is an example of investors who are helping provide funding for startups. Regardless of the kind of investor that we're talking about, though, they invest while the company is still private in hopes that they will realize a large gain at some point when the company goes public. So some private companies may decide to go public. And to go public means to sell shares of ownership to investors in the public markets rather than privately traded amongst investors. So theoretically, this means they are going to share control with random strangers because anybody can buy shares in the stock market. If a company decides to go public, there's a major shift in the corporate structure and management. And once it becomes publicly traded, it falls under regulatory scrutiny of federal and state governments and must regularly file financial reports and analyses. So recall I mentioned private companies don't have to share that kind of information to the public, but once you become public, you have to regularly, like say once a year, provide financial information. Now, when the company's private, it has a private board of directors, and they must authorize how many shares can be issued when they decide to go public. Since issuing shares means opening up the company to more owners, only the existing owners have the authority to do so. Companies want to go public so that they can raise large amounts of capital to expand products, operations, markets, or to improve or create competitive advantages. And so once they've decided to authorize shares, this is considered going through an initial public offering or IPO. So the primary market is when new securities from a company are issued for the first time. That's when the board of directors authorizes how many shares they're going to sell to the public. So you can see here in the primary market, it's the company deciding how many shares they can sell to the public investors. Those authorized shares are then issued through an initial public offering or IPO. Once the IPO happens, the company goes public, and anything sold during this IPO is considered a primary market transaction. When a company goes public, it may be a relatively small number of shares. Its market capitalization, or the total dollar value of its outstanding shares, may therefore be small. The individual shareholders in this case are mostly institutional investors and the original owners. Whenever the stock changes hands after an IPO, it is considered a secondary market transaction. So after the IPO, those that have the stocks, they can now share and trade it with other people on the market. So when people talk about the stock market, what they're really thinking about is the secondary markets. One way to think about it is like when a dealer sells a car brand new, that's the primary market. And then the secondary market is after that car has been sold off the lot, it could be sold again and again as a used vehicle. The difference though with stocks is that the value of the stock can go up and down when you are selling the stock to other investors. And that's where you're going to see potential profits or losses. So let's talk about the types of stock out there. A company can issue common stock or preferred stock. And there are some differences between these two. All companies issue common stock, but not all of them will issue preferred stock. Both kinds of stock will give you a piece of ownership in the company, but only common stock gives you voting rights, while preferred stock does not. And if the company went out of business and had to sell off its assets to pay people out, the preferred stock holders would get paid first, and then the common stock holders would get whatever's left over. With preferred stock, oftentimes there are dividends or income that gets paid to stockholders, whereas with common stock, there's usually not dividends. And then in terms of the dividend rate, with preferred stock, it's fixed, but with common stock, it fluctuates by period. Preferred stocks are better for those that are risk averse and want something more stable and steady. It'll have less volatile prices and more reliable dividends. There's also foreign stocks, but they're a bit more complex, and so they actually get traded through something called an American Depository Receipt, or ADRs. And this helps to lower the risk as it relates to currency and lower transaction costs. Let's talk about the stock value. So the value of a stock is in its ability to create a return or an income or gain in value for the investor. So when you buy shares of a company, you are buying a piece of ownership and you become a shareholder. And the goal is that your investment will make some returns. As the price goes up, you're going to make gains and potentially also dividends, depending on the kind of stock you're dealing with, whether it's common or preferred. And the considerations that will let us know how stocks are valued is the company's cash flow, the latest news or current events, and what its future profits could look like. Corporations exist to make profit for the owners, and the better a corporation is doing, the more valuable it is and the more valuable its shares are. And so a company also needs to increase earnings or grow because the global economy is competitive. A corporation's future value depends on its ability to create and grow earnings. Common market cap categories are micro, small, medium, and large. So when we talk about market capitalization, companies are usually referred to by the size of their market cap, which is the current market value of the debt and equity they use to finance their assets. To categorize the companies by the kind of market cap, it's based on their dollars. So large cap is anything over 10 billion, mid cap is 2 to 10 billion, small cap is less than 2 billion, and then of course there's the micro as well. To figure out the market cap, you'll take the number of shares and multiply it by the stock price. In terms of market cap, it's helpful to invest in companies of different sizes so that you have a variety in your portfolio. Investors have different objectives, whether it's growth or income, different risk profiles, or different investment horizons. So there are a number of stocks with different roles in a portfolio. For example, blue chip stocks belong to stable, well-established, large cap companies. Examples of blue chip stocks would be like Microsoft or IBM. Stocks issued by companies that are developing new products have something called speculative stocks. These usually carry high risk, but there's also a promise of high return. Tesla is an example of a speculative stock. In order to track and measure a company's earnings potential, we use ratios. And recall in Chapter 3, we learned about financial statements. And so the numbers from those financial statements can be used to develop our ratios, which is simply a fraction. The three kinds of ratios that are important to investors to know are return ratios, growth ratios, and market value ratios. Return ratios let us know how effectively an investment is being managed. It lets us evaluate if the highest possible return is being generated on an investment. One of the most useful ratios in looking at stocks is the earnings per share. To calculate it, it takes the net income off of our income statement and subtracts the preferred stock dividends, if there are any, and then divides that number by the average number of common shares outstanding. This kind of ratio allows us to compare stocks to one another and over time, so you can see how the return is doing. When a stock pays a dividend, that dividend is considered income for the shareholder. So some investors who are concerned about the cash flows from an equity investment will focus on dividends per share. So you'll take the common stock dividends and divide that by the average number of common shares outstanding. The DPS is a measure of the company's ability and willingness to pay a dividend, whereas the dividend yield calculates the dividend as a percentage of the stock price and measures a shareholder's cash return relative to investment. So you'll take the dividend per share, divide it by the price per share, both of which are in dollars. So earnings are either paid out as dividends or they are retained by the company as capital. That capital can be used to finance its operations, capital investments, or used to repay debt. Retained earnings is the cumulative net earnings or profit of a company after accounting for dividends. Because dividends are paid out to investors, and so for some investors, they like to see their money sooner rather than later, whereas retained earnings is the eventual gain in the future. Companies can use retained earnings for things like investing in new equipment, research and development, and marketing. Growth ratios indicate how fast a company or its business is growing. Two ratios that measure a company's choice in how it handles its earnings are the dividend payout rate, which is where you take your dividends and compare it or divide it by the earnings, and the retention rate, which compares how much capital is retained to earnings. So you'll take the capital retained and divide it by the earnings. The dividend payout rate and retention rate are complements to each other. So say if your dividend payout rate is 40%, then what's left over is the 60% as part of the retention rate. A company's ability to grow and increase earnings is what creates its value. The internal growth rate lets us know how fast the company can grow without any new borrowing or new shares issued, whereas the sustainable growth rate lets us know how fast the company can grow if it uses some new borrowing, but keeps the balance between debt and equity capital stable. And then there are market value ratios. So this is based on what is actually happening in the market. A stock's market value can be compared with that of other stocks, and the most common way of doing that is to use the price to earnings ratio, where you take the price per share and divide it by the earnings per share. This will let you know if the stock is considered fairly priced, cheap, or expensive. So a low P/E is considered cheap, while a high P/E is considered expensive. Another indicator of market value is the price to book ratio. This compares the price per share to the book value of each share. So you'll take the price per share divided by the book value of equity per share. Now, the book value is the value of the company that is reported on the books or on their balance sheet. Recall the balance sheet has assets, liabilities, and equity. Generally, the book value of a company should be less than its market value, which should have appreciated over time, because the company should be worth more as time goes on. The higher the PB ratio, the better the company has done in increasing its value over time. And you can calculate the ratio for different companies and compare them by their ability to increase value. Now, there are a number of long-term strategies which favor a long-term approach to avoid the volatility and risk of market timing. The first is the buy and hold strategy, which just means you buy stocks and you hold them for a really long time. This is Warren Buffett's favorite strategy. Then there's dollar cost averaging, which is where you buy the same dollar amount of the same stock at regular intervals. This is my favorite approach because it takes out the emotional or the panic that might happen when you see stocks going up or down. Then there's direct investments, where you're purchasing shares from the company. There's dividend reinvestment. So this is having your dividends automatically invested in more shares rather than taking it as cash. And then there's indexing. So this is where you'll invest in an index fund, which is a diversified asset rather than select stocks. I also really like this strategy as well. I do have some stocks that follow the buy and hold strategy, and I'm just hoping everything works out fine in the long run. And the reason I use such long-term strategies is really to build up my retirement fund. Of course, there's also short-term. So short-term stock strategies rely on taking advantage of market timing to earn above average returns. Some advisors believe the stock market fluctuates between favoring value stocks and growth stocks. So day trading became popular in the 90s when stock prices were riding the tide of the tech stock bubble. It is possible to hold a stock for just a few hours and earn a gain and then sell it. So day trading is a very short-term strategy of taking and closing a position in a day or two. In other words, you're buying in the morning and selling in the afternoon in order to gain a profit.